Well, Anand Shah is now joining us. He's Head Portfolio Management Services and Alternate Investment Funds at ICICI Prudential Asset Management Company. He's joining us now on the program. Anand, good to have you with us here. Thank you very much. I have the data from PMS Bazaar, which ranks, PMS schemes and alternate funds, etc. And I think this is data till the end of December 2022. Congratulations. I mean, across large cap, multi cap, mid cap, small cap categories, ICICI Pru has done very well over a 3-year CAGR basis. The numbers look quite good. So congratulations to you and your team.
Thank you.
What from here? I want to just start with mid caps and small caps, Anand, because that is also something that you spend a lot of time and energy on, finding the next winners. Are we at the not the cusp, but are we in the midst of a broad up move for the mid and small cap part of the market, which is going to last for which will be with us for some time? And what are the tailwinds, drivers really for this space from here out? Go on.
Yeah. Hi. Very good afternoon. So if you were to just step back, and we've been talking about manufacturing for a while. So in my all the previous our interactions, we have spoke about it. So a lot of credit to the team. We've been able to capture many turnaround stories within manufacturing early on in our strategies, and that's been sort of helping on the fund performance. Coming to mid and small cap, to be very honest, a lot of manufacturing allied businesses, which are generally the ancillary businesses to the large businesses, have been struggling for a while. And no wonder mid and small caps actually had a very difficult time. And that reflected in the NPAs in banks also to some extent among the smaller companies. I think that's all behind us. We believe the environment generally in the economy has improved. The profitability is more now wider, in the sense large segments of the market, more sectors in the market, more companies in the market is contributing to the overall profitability of India Inc., which in turn then reflects into the turnaround in the mid and small companies. So I think if I were to summarize, yes, manufacturing is looking up, and a lot of mid and small cap actually operates in that segment of the market. So we remain quite sanguine. We've been continuously evaluating businesses in both financial services side as well as within the manufacturing allied for our portfolios. And we like the earnings growth very much, but even the valuations are fairly attractive in that segment.
All right. Hi, Anand. Good afternoon. Nigel on this side. I'm looking at your Contra fund, your Flexi fund, and your other one as well. You seem to be having some exposure to metals, both the large cap names as well as some of those mid-sized companies. What's your view? Because on a day-to-day basis, actually, the Chinese data is looking a little bit disappointing. This morning as well, we got some Chinese data which was a little bit disappointing. So how would you approach this space? There is some weakness that we are seeing on ground in terms of prices. Particularly on ferrous, how would you place yourself?
Yeah, indeed, Nigel. I think what is happening is while the structural story within the metals is improving, as I've been saying consistently, that the cost of producing ferrous metals in China and even in other developed nations like US, Europe, Japan, Korea would continuously go up as they embark upon decarbonizing the steel manufacturing in those countries. So I think that's the structural part of the story. Having said that, that's not worked in last 1.5 years. We had a severe lockdown in China, which obviously took away a lot of real estate demand in the steel segment, and to that extent, there has been a slowdown there. Obviously, China reopened, and they have been sort of producing a lot. Having said that, we still see, as you rightly said, we still see weakness in the data in China, and as much as in terms of real estate, and to that extent on the steel side. But I think still, I continue to maintain that as China becomes more prosperous, you would see that they will embark more and more in decarbonization of their economy, which includes steel. And that means that structurally the steel prices will remain more constructive. When we come to India, I think companies had a very difficult time. In last decade, they were leveraged. Obviously, the competitiveness was very low. All that has changed. Many companies have fixed their balance sheets, they've fixed their debt. And to that extent, I think both top down and bottom up, many of these businesses are today more stronger on balance sheet, more capable of withstanding the lower metal prices today than they were a decade.
Okay, all right, got that, Anand. Good afternoon. Just looking at your portfolios across different schemes. Industrial giant like L&T manages to, of course, find a mention here and there in several of the portfolios, and you have smaller companies as well from the automotive space or niche manufacturing space. What's the thesis that you are going with? And this is a very large, segment otherwise. So, what's the specific bent of mind with which you're approaching? Whether you call it capital goods or you call it, heavy industry or engineering, what kind of companies make the cut for you?
No, so I think if you see since global financial crisis, I think there has not been a great capex, and both private sector, or in particular, was sort of couldn't revive from that crisis. Obviously, we had a lot of investments then. I think that's changing slowly and steadily. Government capex leads in terms of the intensity with which and the growth that we are seeing in government capex. More importantly, if you recall 2019, we gave a lower income tax rate for the new capex. We have seen PLI, Atmanirbhar. So I think somewhere import substitution is also something which is important. On top of it, you have heard this time and again of late, China plus one, Europe plus one. So again, there is a need for an alternative manufacturing location, and India is emerging as one of those countries where you have capacity, capability, and also intent. So I think when I see so many factors coming together, my take is, India has lost a lot in terms of manufacturing. Manufacturing as a percent of GDP has really fallen off. We had become a lot, or we are today a lot services oriented. IT services and financial services form a large part. But I think manufacturing is important if you have to employ such a large population that we have, and we can't be importing and consuming, goods. I think in that sense, if I were to just summarize, real estate drives one segment of the capex which is doing very well. We've heard that from many market participants. Government capex is doing well. I think what we are waiting for is a private sector capex. Again, the ingredients are there. Last 2 years, we have seen deleveraging within the corporate India, but also the balance sheets of banks have strengthened a lot. So the banks have capability to fund the private sector capex. Private sector capex balance sheet has today ability to borrow from the banks. And now if the demand, which sort of got pushed back by a year because of the global energy prices and global slowdown and destocking, I think sooner than later, but I think somewhere the private sector capex should also start contributing to the overall positivity that we've been seeing in manufacturing and manufacturing allied like cap goods, industrial products, and construction companies.
But Anand, this manufacturing is now no longer, it's a fairly discovered sector, discovered theme. A lot of people have been talking about it for the last 12 to 18 months. Stocks have done well. The order book has been expanding. The companies have been reporting good numbers, and valuations too have soared. Do the valuations of these companies make you a bit wary and cautious? Are you okay to invest at current levels?
Indeed, I think some of the companies have got re-rated, but in the same breath, let me also tell you, some of the companies have actually underperformed their earnings growth rate. So, yeah, there are two elements. One is the quality element within this. Some of those cap good companies, the ones which have technology edge and others have got re-rated. But many are low end of manufacturing, the commodity manufacturing space. There actually the companies have done much better. But they've got derated. So it's a mixed bag. Overall, even today when I see my portfolios or we see as an entity, the manufacturing allied, even today it would be trading at a discount to the overall, the valuations that market trades at. Even today we have a significant premium in the consumer-facing businesses, while their earnings have been sort of growing slower than this area, but they have a significantly high return on equity, which in turn today unfortunately is attracting more competition. But that's the case, and that's why they are trading at a much higher PE multiple.
Okay, got that. Anand, so before we let you go, I mean, a broader question on the overall mood, the texture and the nature of the market and market participants. What do you make of things? I mean, a long 18-month wait to get back to these near all-time high levels. What's the sentiment like? Do you think the market is ripe for a real breakout and a meaningful up move above the, say, 19,000 mark? And if indeed that happens, then where do you think the next leg will come in from? Will it be more mid-cap, small-cap, micro-cap led? What themes might, say, outperform over the next 6 months as we get to the end of the year?
No, indeed, it's been a long 18 months. I agree with you. But I think a lot of internals have changed within the earnings also. If I see a total breakup of earnings of the India Inc., I think banks have significantly raised ahead. So banks now form a significant part of the overall profitability of the India Inc. So that's one. What we have also seen is a significant de-rating in a very expensive consumer-facing businesses, while some bit of re-rating in manufacturing. I think they're still apart, but that's also something that has happened in the last 18 months. More importantly, we saw one round of funding available to the startups, which have a lot of growth, but very little profitability. I think there also the sentiments have changed. People are asking for profits at this point of time. So while the market is going back to where it started off 18 months back, but I think internally a lot has changed. Coming to outlook, I think, as I said before, the breadth of the profitability is significantly improved. More number of companies are doing better than less, which was not the case pre-COVID, if you recall, where a very small set of businesses to drive the overall profitability. Today, it's fairly wide, and to that extent, more number of companies are doing better than was as we speak. So that's one significant ingredient. Within that, again, both manufacturing related consumer-facing businesses, banks, everybody is, if you are well behaved and if your balance sheet is strong, if the business models are right, I think there is a right to win. So that's another element. So overall, the alpha creation has been much better in last few years than it was before. So the stock picking opportunities are much more. Similarly, mid and small cap again offers you much more stock picking opportunity as we speak, and that's where the alpha is also being generated for many of our domestic mutual funds and PMSs. Coming to the lead the earnings growth, I think banks are clearly leading at this point of time in terms of the quality of balance sheet as well as quality of earnings.
All right, Anand, always good hearing your thoughts. Thanks so much for joining in and filling us in with your view on a whole host of sectors. By the way, the markets have moved to the low